Please visit tradingsim.com to simulate this trading lesson. Alright, this is Al Hill from tradingsim.com. Today we're going to look at another basic strategy here. We're going to look at DELL, which does not have a lot of volatile moves, but DELL exhibited a trading range going into the June 24th open. And as you can see here, it was a upward move, pretty tight range, and this was in a greater context of a downward move. And as you can see on the 24th, we actually gapped down beneath that level, and we did so on some decent volume, not too insane, but some decent volume. So here, a simple strategy is to, when you have a tight range the previous day and you gap down through it in the open, is to take a position in the direction of that trend. So we're going to sell short 10,000 shares at market, average price 1366, and what you'll want to do is put a stop market order slightly above the open of the candle, above that that kind of starting point. That way, if you get a reversal, you can quickly get out of the position. The reason why it's good to take a short on the open on this one is you can kind of see you have this upward trend line here. So if you were to actually go back up and test this line, it would be a much harder challenge because now the line is still rising up. So it requires you to not only reverse the gap, but to exceed the opening high, all of it, and kind of go back up to test the line here. And so as time is a factor here as well, the stock would have to go back up to 1388, upwards of 1390, in order to have a successful back test of the trend line. So to protect ourselves, we can put a stop market order around 1384, and then that will prevent us from losing any additional money, right? You always want to protect yourself. And so here you have your open position, you have your stop. Now you just let it ride. All right, so let's fast forward here. And as you can see here, of course, they're kind of fighting it a little bit, but clearly this is a downward move, and then now you're up 1.46%, close to $2,000. Now, of course, your exit strategy will be dependent upon your holding period that you have, the amount of money you want to target. That's all going to be dependent upon your own trading preference. But the setup is clear here, right? You have a trading range that's going counter to the primary trend, right? It's retracing the primary trend. You have a gap down through that upward or downward, if you're going long, right? Channel, and you take a position in the direction of that move, and you place your stop slightly above the open of the candle for that day. And you also keep in mind that, again, if you have it sloping up and you're going short, you have a greater chance of it not back testing it because it's not a horizontal line, right, going straight across. It's actually sloping up, which means it will require more juice to go back up to test the line. All right, good luck trading.